Good morning. I'm James Lopez, president at HomeFi Corporation, and this is today's mortgage and real estate market update. Now, we're going to bring to you some data this morning from FHFA and from Case-Shiller. There's a lot of numbers in the data this morning, and so I'm going to have to look at my sheet this morning to give you some of these numbers and remember them. I can remember them all. So just want to let you know, if I'm looking away from the camera, it's because I'm looking at this data that came out from FHFA and Case-Shiller. So jumping right into it, Case-Shiller is the home price index from Case-Shiller is considered the gold standard for appreciation nationally. So whenever this data comes out monthly, this data is very closely watched and looked at and considered, like I said, the gold standard for data as far as home appreciation goes. So in February, the Case-Shiller Home Price Index showed that home prices increased by 1.7% and 19.8% year over year. So in February, home prices were still accelerating as far as appreciation goes, because that's up from 19.2% in the previous report. So January home prices were up 19.2%. In February, home prices were up 19.8% according to the Case-Shiller Home Price Index. Now, there are three. They also release data about the top cities as far as which top cities are appreciating the most. Two of those cities are in. I'm going to let you guess. Leave a comment. Let me know what you think, where two of the top three cities are located in. All right, now FHFA released also their house price index. It's a very similar report, but there's a subtle difference. The FHFA house price index report only measures single-family homes with conforming loan amounts. So the conforming loan amount is around $647,000. So the FHFA our house price index only measures appreciation for homes that fall within that conforming loan amount. Now you can have a $1 million house that has a loan amount under 647, so that's possible. But as a whole, the FHFA index really kind of measures the appreciation for lower priced homes. Now again, FHFA, the home price index for FHFA rose 2.1% in February, and it's 19.4% up year over year. And that's, again, an acceleration from the previous report, which was 18.3%. So what we have is that we've got these two very well-renowned indexes that are showing that home prices are still increasing. But here's the kind of rub on that data. That this data is from February, and that's kind of before interest rates started to really increase. So it's good data, and shows that home prices are still increasing, but it hasn't really taken into account yet the data from March and how interest rates has affected that data. Now here's the deal, and this is something that we've been talking about for a few weeks now. There's not a lot of inventory, so inventory is the lack of inventory and the high demand for homes is still what's keeping home values elevated, and as we see in these reports, they're increasing. They're still accelerating, actually. So going from 18.3 to 19.4% year over year values, that's an acceleration, right? So the value, the percentage is going up. Now we don't expect that to continue through the summer and into the fall. Through quarter three and into quarter four, we don't expect that appreciation to continue to accelerate. We expect it to start to decelerate, but we don't expect it to go the other way. And there's a lot of talk in the media about housing bubbles and stuff like that. We just don't see that happening. There's too much demand, not enough supply. And as we get into the purchasing season and people during the summer months, people start to list their homes for sale and things like that. As we move into that season, what we see is that the supply really starts to meet the demand, and we see a deceleration in home values, but we don't see it going backwards. So that's kind of what's going on in the real estate market right now. Jumping back into mortgage bonds and the financial markets. Mortgage bonds today are right now they're down 17 basis points based off of yesterday. The 10-year yield is down 1 basis point based off of yesterday. But again, this morning mortgage bonds have been very volatile. So they've been up and down, and where they are, it's just hard to say where they're going to land today. The good news on mortgage bonds is that what we see is we're still seeing that continued the leveling out, or the foundation that's starting to build for mortgage bonds to start to move in an upward direction. What that means for interest rates as far as the 30-year fixed rate today. 30-year fixed is probably going to open up about where it closed off yesterday because it's so volatile so far this morning. So rates will open up about where they closed off yesterday, and there's room to go either way. So we could have some repricing for the better, for the worse. Again, what we talked about yesterday is that most of the lenders who are a little more risk averse, which is most lenders, right? There wasn't a lot of repricing throughout the day yesterday. Interest rates kind of held where they were when they opened up. We kind of expect to see the same thing from interest rates today. They should hold where they are when they open up today, about the same where they were yesterday, but we'll see what the day holds. All right, so that's all we have for news today. I hope you have a wonderful day, and we will see you tomorrow.